So yesterday we talked about the federal government's budgetary policy, its spending and taxing powers, in light of a recent Congressional Budget Office report that indicated that over the next 20 to 30 years, if we didn't make any changes in current spending and taxing policy, the size of the national debt would double in relation to GDP, from about 3/4 of gross domestic product to about 1.5 times gross domestic product. We focused mostly on the spending side and looking at the difficulties in reducing spending, particularly in light of the significant portion of the budget that's taken by entitlement programs. So today I want to focus a little bit on the taxing side, because government power to collect revenue, if government spends, then it can pay for that spending in a couple of ways. One, it can pay for that spending through its taxing power, and to a minor extent charging fees for services. And two, it can pay for that spending by borrowing if the taxing isn't enough to make up for all the spending. So where do we stand with respect to the government's taxing and spending powers, and in light of both the Congressional Budget Office report and the coming debt ceiling at the end of this month? So let's look at first the prospects for funding the federal government's budget deficits, annual budget deficits through taxes. And there are a couple of primary sources of taxes, mostly based on the income of individuals or the profits of corporations. So let's first look at the individual taxes. President Trump and his Secretary of the Treasury have promised a reduction in middle-class taxes, and certainly nobody's going to complain about having their taxes reduced. But in light of the projected federal budget deficits, and the fact that most of the tax revenue, at least income tax revenue, comes from the middle class, there are going to be trade-offs in terms of tax reduction versus budget deficits. And further, by reducing the taxes of the middle class, ultimately what will also happen is the wealthier people will also have their taxes reduced as the overall tax rate comes down. So reducing taxes, there's one theory that says if you reduce taxes, it will result in so much economic growth that even though people are paying a lower tax rate, the total revenues of government will increase. This is what's called so-called supply-side economics. Most studies over the past 30 or so years since we've had the last significant tax reform that was in the 1980s have shown that cuts in taxes really don't result in more revenue for government. So the result of tax cuts, income tax cuts, will likely be lower government revenues, increased deficit, increased debt, and more federal government borrowing. A second source of taxes, significant source of taxes, is through corporations. And there's a good deal of talk too now about reducing the corporate tax rate, and the President's also promised to reduce the corporate tax rate. Currently the corporate tax rate in the U.S. is 35%, among the highest in the world. And there have been several proposals floated to reduce the corporate tax rate anywhere from 28% to 15%. And again, while there's some thought that this may stimulate more economic growth through a lower tax rate, what's also likely to happen with the reduction of corporate taxes is that there'll be fewer deductions, and some of those deductions are deductions for investment spending that enhances growth. So I guess the bottom line is that there are always trade-offs in cutting taxes, and the consequence of cutting taxes will likely be a higher government deficit, more debt. And so what are we to do? Well, let me float an idea that really hasn't been considered yet, but may be, that I want you to sort of keep in mind. And that is, if you've ever traveled to European countries, you note there's something called a value-added tax that's often added to your purchases. And a value-added tax is a consumption tax on consumption rather than a tax on income. In this country, we get most of our federal income taxes through taxes on income, but very little tax on consumption. At the state level, there are sales taxes, and the local level, sales taxes, so we do tax consumption. We tax some consumption in the form of a gasoline tax, but not much. So a value-added tax would tax the production of goods would tax the final goods and services at each stage of production, and would be paid at the time of purchase. If we need a substantial source of revenue, the value-added tax offers two benefits. One, and may be politically feasible. It's a very easy tax to collect, and results in an awful lot of revenue. And for that reason, Democrats would likely favor a value-added tax. The value-added tax, as all consumption taxes are, is also a regressive tax. That is, it takes a larger proportion of taxes from the income of lower income people than higher income people. And in that way, it might be more appealing to Republicans, who seem to favor more regressive taxes. So I guess the word is, keep your eye out for a value-added tax in the mix if the current discussions of tax reform don't go anywhere in Congress in the next couple of months. Thanks so much.